Hello everyone, welcome back to Fundrise Finance. The month of August started very weak in the markets with August 5th, where we saw a steep dip in the S&P 500 and also the exchange markets in the initial part of August. But then it gradually recovered and we saw a nice healthy upswing. The market leadership moved from technology stocks towards financials. You can see in 1 month, financials outpacing the technology. Yes, ever so slightly, but still, it's good to see a different sector take the lead for a change. But still, we can see year to date, technology stocks taking a big lead over every other sector. But no matter what happens in the market, as long as we're invested into good stocks and ETFs, they should do good in the long run. And that's what I want to discuss in this video. How much my portfolio earned as dividends for the month of August. So without any further delay, let's get started. So this is my Fidelity portfolio. This current value is $119,284. Looking at the dividends in this portfolio, here we can see I filtered from August 1st till the 31st. You can see starting right from the beginning of the month all the way till the end. Now I downloaded all of these into an Excel file to go through. So first we have $3.99 from the DEVO ETF, $7.56 from Verizon, $6.33 from Toronto Dominion, $18.06 from JP ETF, $21.17 from JEPQ ETF, $5.81 from Lowe's, $1.32 from General Dynamics, $1.38 from MasterCard, $5.70 from Air Products and Chemicals, 1 cent from SFlow ETF, 6 cents from VFlow ETF. Now these two are relatively new positions in my portfolio. $3.99 from Texas Instruments, $4.09 from Northwest Bank Shares, $1.87 from Abbott Labs, $3.19 from AbbVie, $2.50 from Apple, $1.25 from Hormel Foods, $8.29 from Kinder Morgan, $5.72 from Morgan Stanley, $2.68 from Procter& Gamble, $4.78 from Realty Income, $1.22 from AO Smith, $4.09 from Accenture, $1.43 from Caterpillar, $4.83 from Citigroup, 76 cents from Charles Schwab, $35.40 from Conagra Brands. Now I own 100 shares of this stock on which I do options. $1.49 from Paychex, then 18 cents from the DGRW ETF. Again, another relatively new position in the portfolio. Then together, $44.12 from Arbor Realty Trust. Then $45.42 from SPAXX. Now this is a money market fund in Fidelity where the cash in my portfolio is held. That currently generates like 5% interest with the current interest rates. Now, as Fed keeps cutting the rates going forward, that will keep coming down, but still way better than holding your cash in regular bank account. Then finally, $6.32 from Starbucks. Now, this is the Google Sheets where I track all my portfolios. You can see the portfolio value currently $119,223. Slightly different from the value that we saw earlier in the Fidelity website. That's because of the options values that keep fluctuating. And this portfolio currently generates 2.91% as the dividend yield and generates almost $3,465 as the dividend income. And so adding up all the value that we saw earlier, it comes down to $255.01. So that's the dividend income for the month of August. For the 2 months in this quarter overall, we have $650.04 generated. And for the year so far, we have $2,100.22. Now, like I always say, this is my favorite chart, dividends by quarter. Here we can see the 2024 Q3 value. So by end of September, that's when the Q3 finishes. I hope to see this value much higher than what it was in Q2. So that, let's see what we can expect as dividend payments for the month of September. Now, typically my September month, that's like basically the third month of the quarter, is my highest paying month, where I get the dividend payments not only from the stocks in this portfolio, but also almost all the ETFs in my portfolio pay me in the third month of the quarter. So here we can see the expected payments, at least for those which have been declared till now. First, we have WEC Energy, then we have Ford, Leandel Basel, Pfizer, Visa, Walmart, Zoetis, Cummins, UPS, Amgen, Honeywell, Sherwin-Williams, Chevron, Emerson, Johnson Johnson, Rockwell, Target, Tractor Supply, Applied Materials, Home Depot, Microsoft, Realty Income, Parker Hannifin, Whirlpool, Google, which recently started to pay the dividends. This should be the second payment till now. And your next Energy, McDonald's, L3 Harris, United Health, Qualcomm, Bank of America, T. Rowe Price, Waste Management, CTO Realty, Devon Energy, PepsiCo, and finally Union Pacific. When we sum up all these, we see a value just more than 119 bucks. So when I add this 119 to the current value of 650, it comes down to 770 bucks. So yeah, uh, projected forecast for end of Q3 is higher than the Q2 value. That's what we want to see. Your dividends growing over time with new principal being added and also the reinvestment from the existing stocks and ETFs. That's what we want to see, the snowball effect taking shape. When you look at the overall dashboard, I used to maintain this when I had my M1 Finance and Acorns accounts also, in addition to the Fidelity. Now I have merged all of them into the Fidelity portfolio. I've made videos in the past why I chose to move out of M1 Finance and Acorns. Please do check them out. So this sheet I maintain because of the longer dividends that I get to track. I can say going all the way back to 2018 Q1, almost 1.5 year or almost 2 years, I never paid attention to the dividends at all. But then towards the end of 2019 is when my focus shifted to dividend investing, and that's where you can see the bars going higher and higher. Here we can see the sector breakdown. The ETFs make up almost 34% of the portfolio. That's what my intention is, to have a 35% in ETFs and 65% into stocks. But right now I have a cash holding of 8.5%, which I can deploy as and when necessary. The markets have gone up too high too soon, in my opinion, from the lows that we saw in early August. And September usually is a down month in the market. That's a seasonality. I don't know why and what, but that's how it is. Like toward middle of September through middle of October is when the markets get volatile for some reason. So here we are on Seeking Alpha, looking at the ETF SPY that tracks the S&P 500. There's a great feature on the Seeking Alpha website wherein we can see here basically the month of September is the weakest month in the entire year, giving us a win rate of 30%. And we can see on a 10-year average, it returns a negative 2.6%. So this is a great feature to see the seasonality, the patterns. Yep, Seeking Alpha has many such features which you can make use of by being a premium subscriber. You can use the link in the description notes to become a premium member, and that's one way you can support this channel. You can see information technology is 12.1%, then financials is 8.3, then discretionary at 8.1, then staples at 6.1, then we have industrials at 4.7, real estate is 4.2, healthcare is 3.6. This is where I want to increase my exposure. I want to bring this healthcare up at least up to 5%, if not more. Then I have utilities at 2.5 and finally energy at 1.7%. Then another chart here is the unique is my dividend income by sector. Here you can see the ETFs contribute to the most of them, followed by financials and then by consumer staples. And this chart is the portfolio value over time. Then with equity style, in which we can see it's predominantly large cap value at almost 35%, followed by large blend at 28%, and then large growth at 24%. So yeah, we can say it is large cap tilt with a little presence in the mid cap space of I would say close to 8%. Now this is where the monthly dividend split, like I said earlier, the third month of the quarter is the highest paying. In this case, we can see it's almost 55.5%, followed by every month payments like the JPs and the JEPQs, which pay every month. Then we have the first month of the quarter at almost 15%, followed by the second month, which is 12.2. And finally, we have a teeny, the semi-annual ones like Disney and the international ETFs, which pay every 6 months, and that's like 0.4%. You can see the dividend income by assets. Almost 35% of the income is from the regular stocks, the common stocks. You can see the 13% is from the REITs. Cash currently paying 5% is what is almost 15%. Then your income ETFs, the JPs and the JEPQs, which is like almost 15%. And then the ETF payments is like 23%. Looking at the income goals that I set for myself at the start of the year, I have crossed it and went beyond. The goal was for 3,000. Right now I'm at almost 3,465. So that's like 115.5%. I need to change it, but I don't want to right now because I know, as we saw earlier, 15% of the dividend income is being contributed by the cash reserves. As and when that cash reserves get used up into corresponding holdings, their dividend income value will come down. So I don't want to tinker with this value right now. I'll take a look at it later. Likewise, the 5-year one, which is at 3,500 by end of 2025, which we are almost hitting it. We'll revisit these values later. Now, looking at the other dividend metrics, we can see our current portfolio generates almost 289 bucks as the monthly dividend. Weekly, it is almost 67 bucks. A daily, which is like 365 days, it's almost $9.50. And at a 24-hour level, it generates 40 cents. And at an 8-hour workday, that's if your portfolio goes out to work, currently it earns $1.67. These are fun metrics, but they tell you that whether your portfolio can survive in your day-to-day life, like your 8-hour workday. Currently, it's $1.67. It's not as high as your actual wages right now, but maybe towards as we keep investing, as the portfolio keeps growing, the snowball effect and everything, this workout dividend should catch up with your daily wages at least. That's the goal. So yeah, that's what I want to discuss in this video with you all. Hope you all liked it, and if so, I would really appreciate if you could hit the like and subscribe buttons so that YouTube can suggest this video to many more people out there. Until we meet in the next video, let's try to do as much as possible to be financially healthy and keep taking those small strides towards financial freedom. See ya.